Most business owners know that they need an accountant when it comes time to sell. But if you ask them exactly what the accountant does throughout the process, a lot of them couldn't tell you. They know there are fees going up, they know that emails going back and forth, but what does the accountant actually do? In this video, I'm going to walk you through exactly what the accountant does during a business sale. Not just as importantly, but what a good accountant understands the business sales does that as a general one does not. Because this is the one area the right advice can make the difference between the deal goes, but how much money you actually end up with at the end. Why you need a specialist? Just like your lawyer, the accountant you need for your business sale, not necessarily the same accountant that does your end-of-year books. Your ready accountant knows your business well, they know it's valuable, but the business sales has its own tax consideration, their own conventions, and their own timing pressures. An accountant who does this regularly will know what the buyer's looking for, how to present the numbers in the best light, and how to structure the deal to minimise your tax bill. If your current accountant has done several of these business deals in the last 2 to 3 years, they're probably the right person. If they haven't, it's worth asking whether they have the right experience or whether you need someone along who does. So what does your accountant do stage by stage? Here's what a good accountant is working on throughout the sales process. Before you even go to market, get your numbers in order. The best time to accountant involved is before you start talking to the buyers, not after. A good accountant will review the last 3 accounts and identify anything that needs explaining or tidying up before the buyer sees it. Owner-managed businesses often have personal expenses running through the company. A car, a phone, travel, perhaps some costs that sit in a grey area. The buyer's accountant will find these during due diligence. Your accountant's job is to identify them first, present them clearly so that it doesn't look like something's being hidden. They work out the normalised profit figure on a like-for-like basis, stripping out the one-off costs, personal expenses, and anything else that won't be under the new owners. This is the figure that underpins the valuation, so getting it right matters. During due diligence, supporting the information requests. Once the head of terms are signed and the due diligence begins, the buyer's accountant will send you a detailed list of financial information they need. Your accountant's job is to help you respond to this accurately and promptly. Think of it like a financial checks on a mortgage lender does during approval of a loan on a house purchase. They want to see proof behind the numbers, the VAT, the corporation tax, the management accounts, the bank statements. Your accountant can pull all these together and make sure that he tells you a clear, consistent story. On a practical tip here, don't wait for the full accounts to be prepared before you share the information. VAT returns and corporation tax are really already filed and can be shared immediately. Getting those across early keeps the process moving and signals to the buyers that you're organised and straightforward to deal with. Advising on the deal structure. This is where the specialist accountant really earns their fees. How a deal is structured can make the difference between how much tax you pay on your proceeds. The main consideration for most sales of business asset disposal relief, formerly known as entrepreneur's relief, which allows the business owner to pay capital gains tax at just 10% of the sale of their shares rather than a standard rate. To qualify, there are specific conditions that need to be met. How long you've owned the business, the type of shares you hold, and how the deal is structured. Your accountant will make sure this is all set up to qualify before completion, not scrambling around to fix it afterwards. They'll also advise you on how deferred payments are treated as tax purposes, whether it's an earn-out structure has a particular tax implication, and how to handle the cash surplus in a business as part of the deal. Liaisons with the buyer's accountant. During due diligence, there will be questions and queries from the buyer's financial team. Have an accountant available to respond to these directly, rather than having them routed everything through you, speeds up the process significantly and avoids misunderstandings. Some tellers are reluctant to introduce the accountant to the buyer early in this process. In my experience, it's most always better to do it. Accountant to accountant conversations are efficient and technical in the right way. They cut out the back and forth and they can slow the deal down. Post-completion, handling the tax. Once the deal is done, your accountant handles the tax return and reports the sale calculations to the capital gains tax due. If the business asset disposal relief applies, that's a 10% rate on qualifying gains. If it doesn't, the rate is a lot higher, which is why getting the structure right before completion is so important. They advise you on what you can do with the proceeds, whether that's reinvesting them, drawing them down, or other considerations that are relevant to your personal situation. What to prepare before the accountant starts. The more organised you are, the more efficient the accountant can work, and the lower fees will be. Before you start the sale process, it's worth making sure that your following is in good shape. 3 years filed accurate accounts, VAT returns for the last 3 years, corporation tax returns, and any correspondence with HMRC. Up-to-date management accounts, ideally within the last month or two. Bank statements, a clear record of any personal and one-off expenses you run through the business. Details of any other standing liabilities and HMRC queries. The clearer your financial records are, the faster due diligence moves. And the faster the due diligence moves, the sooner you can get to completion. One thing sellers get wrong. The most common mistake I see sellers make with their accountant is leaving them out of the conversation until it's too late. By the time heads of terms are signed and the due diligence is underway, some of the most valuable things the accountant can do, tidying up the numbers, structuring the deal correctly, making sure the business asset relief applies, have already been decided and are much harder to change. Bring your accountant in early, ideally before you start talking to a buyer at all. The cost of their involvement at the stage is modest compared to the difference it can make at the outcome. Your accountant plays a critical role in the business sale, not just keeping the paperwork moving, but making sure the deal is structured in a way that favours yourself. Choose someone with experience in business sales, involve them early, make sure the financial records are in good order before the process begins. Those 3 things will make the whole experience significantly smoother. In the next video, I'm going to cover how long the process takes. It's what main causes the delay and what to watch out for. So if you're finding this series useful, subscribe so you don't miss anything the rest of it. And if you would like a private conversation about your own situation, get in touch. The link is down below.